Forget everything you thought you knew about safe haven investments. In 2026, the quiet hum of AI servers isn't just processing data, it's igniting an economic war for gold. Could the very technology designed to optimize our future unwittingly send gold prices to unprecedented highs, redefining global wealth and leaving traditional financial models scrambling? That's exactly what we're dissecting today. And by the end of this video, you'll understand why this isn't just another market trend, but a fundamental restructuring of how we think about economic stability and wealth preservation. The year is 2026, and a silent battle is raging for the world's most precious metal, driven by a force you least expect: artificial intelligence. As AI's energy footprint explodes, it's quietly creating a never-before-seen economic vulnerability that's forcing investors, central banks, and financial institutions to completely rethink their strategies. Your understanding of financial stability is about to be completely rewritten, and what I'm about to share with you is based on real data, real market movements, and real shifts happening right now in the global economy. Let me start by explaining what happened in late 2025 that changed everything. The explosive growth of AI models created an unprecedented energy demand that nobody saw coming at this scale. We're not talking about a gradual increase in power consumption. We're talking about data centers literally burning through electricity at rates that are straining power grids globally. These aren't the energy projections that analysts expected to hit until the 2030s. They arrived a full decade early, and the infrastructure to support them simply wasn't ready. A single large-scale AI training run can now consume as much energy as a small city uses in an entire month. And when you multiply that by thousands of facilities operating 24 hours a day, 7 days a week, across every continent, you start to understand the magnitude of what we're dealing with. The numbers are staggering. In 2023, global data centers consumed roughly 460 terawatt hours of electricity annually. That's already a massive amount of power. But by 2025, that number had doubled. And by early 2026, we're looking at projections exceeding 1,200 terawatt hours. To put that in perspective, that's more than the entire annual electricity consumption of Japan, one of the world's most industrialized nations. This isn't just about tech companies using more power. This is about a fundamental shift in global energy allocation that is creating ripple effects across every sector of the economy. Power grids that were designed for gradual, predictable growth are now facing sudden, massive demand spikes. Regions with heavy concentrations of data centers are experiencing rolling blackouts. California, Virginia, Ireland, Singapore, these aren't just random locations. These are the global hubs of AI infrastructure, and they're all facing the same crisis. Energy prices in these regions aren't just rising gradually, they're spiking in ways that correlate directly with AI infrastructure build-out. When a major tech company announces a new AI data center, energy futures in that region immediately react. This is creating a new kind of market dynamic that traditional energy economics wasn't built to handle. But here's where it gets really interesting. This energy crunch isn't staying contained within the tech sector. It's rippling across every industry you can imagine. Manufacturing facilities that depend on stable electricity prices are seeing their costs rise unpredictably. Transportation companies are paying more for power. Even basic utilities in residential areas are experiencing price volatility that residents haven't seen in decades. Industries that built their entire business models on the assumption of cheap, reliable power are suddenly finding that assumption challenged. And when energy becomes expensive and volatile, when the foundation of modern industrial civilization starts to crack, markets begin looking for stability in places they haven't looked in generations. Energy has become the bottleneck for AI development, and that's creating a resource scramble unlike anything we've seen since the oil crises of the 1970s. But this is different. This isn't about fuel for cars or heating homes. This is about the computational power that's driving the entire next phase of technological evolution. Tech companies aren't just competing for engineering talent or proprietary data anymore. They're competing for something much more fundamental: electrical power, actual physical access to electricity. We're seeing deals between major AI companies and energy providers that look less like business contracts and more like geopolitical negotiations. Exclusive rights to power plants, priority access to grid capacity, long-term energy futures, contracts at premium prices that would have seemed insane just 2 years ago. Microsoft, Google, Amazon, Meta, these companies are now negotiating directly with governments for dedicated power infrastructure. They're funding the construction of new power plants. They're buying solar farms and wind installations outright. Some are even exploring small modular nuclear reactors to guarantee their own power supply. This isn't normal corporate behavior. This is the behavior of entities that understand they're facing an existential resource constraint. And when the biggest, most cash-rich companies in the world start acting like they're in a resource war, that sends a signal to every other market participant. It says that energy security is no longer something you can take for granted. It says that the stable, cheap power grid that built the modern economy is now a competitive advantage rather than a public utility. The geopolitical implications of this are profound. Countries with abundant energy resources are suddenly wielding new leverage on the global stage. Nations that can guarantee stable power for AI infrastructure are attracting investment at levels that are reshaping trade relationships and diplomatic priorities. Iceland, with its geothermal power, Norway, with its hydroelectric capacity, the United Arab Emirates, with its solar potential and sovereign wealth to build infrastructure. These aren't the usual suspects in the tech power hierarchy, but they're becoming critical players because they control what AI needs most: reliable, abundant electricity. Energy security is now AI security, and AI security is becoming synonymous with economic security and national competitiveness. This is where gold enters the picture, and why what's happening in 2026 represents a fundamental shift in how we think about safe haven assets. Gold has always been a refuge during times of uncertainty. Economic crisis, currency devaluation, geopolitical tension, these have traditionally driven investors toward gold. But what's happening now is different. This isn't just inflation hedging. This isn't just fear of stock market corrections or currency instability. This is investors recognizing at a fundamental level that the foundation of the modern economy, cheap, reliable energy, is no longer given. And when that foundation becomes questionable, when the infrastructure that supports everything from banking to supply chains to digital commerce becomes vulnerable, tangible assets take on a new kind of importance. Gold offers something unique in this environment. It has intrinsic value that doesn't depend on anyone's promise or any institution's stability. It's not vulnerable to power grid failures. It doesn't require electricity to maintain its worth. It can't be hacked, it can't be deleted, and it doesn't need software updates. It's been a store of value for over 5,000 years of human civilization, through the rise and fall of empires, through technological revolutions, through every kind of economic crisis imaginable. And in 2026, as the world confronts the reality that our most advanced technology has an energy appetite we can barely feed, that ancient reliability is looking remarkably modern, here's the correlation that's catching financial analysts off guard. We're seeing a direct, measurable relationship between AI energy costs and gold prices. When electricity prices spike in major AI markets like Northern Virginia or Silicon Valley, gold prices rise within days. When energy futures show volatility in regions with heavy data center concentrations, gold buying increases from both institutional and retail investors. When reports come out about power grid strain or brownouts affecting tech infrastructure, gold ETFs see inflows. This correlation wasn't in any financial models from even 2 years ago. The algorithms that investment banks use to predict gold prices didn't have an input for AI energy consumption, because nobody thought it would be a significant factor. But it is. It's becoming one of the most reliable predictors of gold price movement, and that's forcing a complete reassessment of how we model precious metal markets. Traditional hedges against inflation or currency devaluation aren't keeping pace with what gold is doing right now. Treasury bonds, typically seen as ultra-safe assets, aren't providing the protection they used to, because interest rates are being manipulated by central banks trying to manage inflation that is partly driven by energy costs. Real estate, another traditional inflation hedge, is struggling because high energy costs are hitting construction, maintenance, and property values in regions with unstable power. Even other precious metals like silver and platinum aren't moving in lockstep with gold because they have more industrial applications that are vulnerable to energy price shocks. Gold is outperforming all of them because it is hedging against something entirely new in the modern era: energy instability as a systemic economic risk. Pay very close attention to what central banks are doing, because their actions reveal what the smartest money in the world sees coming. Throughout 2025 and into 2026, central banks around the world have been quietly but steadily increasing their gold reserves. China's central bank has been a net buyer of gold for 18 consecutive months, adding hundreds of tons to its reserves. The European Central Bank has increased its gold holdings for the first time in over a decade. India's Reserve Bank has accelerated its gold purchases. Even central banks in traditionally tech-forward nations like South Korea and Singapore, countries you'd expect to be all in on digital assets and modern financial instruments, are diversifying into physical gold. This isn't coincidence. This isn't sentiment or speculation. Central banks operate on timelines of decades and with access to economic data and analysis that dwarfs anything available to private investors. When they move in unison toward an asset class, it's because they see structural shifts that require fundamental portfolio adjustments. Why are central banks doing this? Because they understand that energy volatility introduces systemic risk into every other asset class. Every stock, every bond, every currency, every digital asset, they all depend on a functioning economy. And a functioning economy, especially a modern digital economy, depends on stable energy infrastructure. If energy becomes unreliable or prohibitively expensive, everything built on top of that foundation becomes unstable. Gold doesn't have that exposure. Gold's value is not contingent on power grids operating correctly, or supply chains functioning smoothly, or digital networks staying online. That independence, that lack of infrastructure dependency, is becoming more valuable with every passing month as AI's energy demands continue to grow and as the strain on global power systems becomes more apparent. Institutional investors are following the lead of central banks, and the flow of money into gold is accelerating. Hedge funds that haven't touched gold in decades, that built their entire strategies around equities and derivatives and algorithmic trading, are now allocating significant percentages to physical gold and gold-backed securities. Pension funds, which have obligations stretching decades into the future and therefore need to think very carefully about systemic risks, are increasing their gold positions beyond what traditional asset allocation models would suggest. Family offices managing generational wealth are buying physical gold bars and storing them in secure vaults. Even some tech billionaires, the very people whose companies are driving the AI revolution and the energy crisis it's creating, are personally buying physical gold. That should tell you something. The people who understand the technology best, who are most optimistic about AI's potential, are simultaneously hedging against the infrastructural vulnerabilities that AI is creating. The sheer volume of capital moving into gold is remarkable. In the first quarter of 2026 alone, global gold ETFs saw inflows exceeding $50 billion. That's not retail investors buying a few coins. That's institutional money, the kind that moves markets and signals major shifts in asset allocation strategy. Private wealth managers reporting that client requests for gold exposure have tripled compared to 2 years ago. Vault services that store physical gold for high net worth individuals have waiting lists. Refineries are running at capacity to meet demand for investment grade bars. The premium for physical gold over paper gold contracts is widening, indicating that investors want actual metal, not just financial exposure. They want assets they can touch, that exist independent of any financial system or digital infrastructure. Now let's talk about why traditional financial models are failing to predict or explain what's happening. For decades, economists and financial analysts have relied on models that worked remarkably well. Models for inflation, for interest rates, for currency valuation, for commodity prices. These models were built on historical data and tested against decades of market behavior. They incorporated factors like GDP growth, money supply, government debt, trade balances, employment rates, all the standard metrics. And they worked because the underlying structure of the economy remained relatively consistent. Energy was cheap and abundant. Infrastructure was reliable. These were constants you could build models around. But AI has invalidated that assumption. AI has introduced a variable that these models weren't designed to handle: massive, sudden, sustained increases in energy demand that create cascading effects throughout the entire economy. Traditional inflation models, for example, don't adequately capture energy-driven cost spirals of this nature. They're built around demand pull and cost push inflation, around monetary policy and fiscal stimulus. They were not designed for a scenario where a single new technology sector consumes energy at rates that strain national grids and drive up prices across every other sector simultaneously. Risk models used by banks and investment firms to calculate portfolio volatility do account for the possibility of power grid instability affecting entire economic regions. They have inputs for political risk, for credit risk, for market risk, but not for the risk that the electricity might literally go out in a major financial hub because AI data centers are consuming too much power. Portfolio theory, the frameworks that tell investors how to balance risk and return across different asset classes, doesn't know how to price the risk of brownouts, shutting down factories, offices, and trading floors. Gold is rising, not because the old models say it should, but because the old models are incomplete. They're based on an economy where energy was a background assumption, not a central variable. In 2026, energy is the central variable, and everything else has to be understood in relation to it. That's why you're seeing gold's price behavior decouple from traditional predictors. It's not moving based on the usual factors. It's moving based on a new calculus that's still being figured out in real time by the markets. And when the models don't work, when quantitative analysis fails to explain price movements, that creates uncertainty. And uncertainty, more than almost anything else, drives investors towards safe haven assets. Consider the domino effect that energy instability creates. When energy costs rise, manufacturing costs rise because production requires power. When manufacturing costs rise, consumer prices rise because goods become more expensive to produce. When consumer prices rise, inflation accelerates, and central banks respond by raising interest rates to cool demand. When interest rates rise, borrowing becomes more expensive, business investment slows, stock valuations come down, and economic growth decelerates. That's the traditional economic cycle, and it makes sense. But here's what's different in 2026. Through all of that, through rate hikes and market corrections and inflation concerns, gold is rising. It's rising through conditions that traditionally would see it flat or declining. It's behaving like an asset that's decoupled from traditional economic cycles. And that's because it has decoupled. It's responding to a different set of inputs now, inputs related to infrastructure, stability, and energy security, rather than just inflation and currency values. Every digital asset, every stock, every bond, every fiat currency, they all depend on systems that require energy to function. Stock exchanges need power to operate. Banking systems need power to process transactions. Digital currencies need massive amounts of power to maintain their blockchain networks. Even paper currency, in a modern economy, depends on electronic systems for most of its utility. Gold doesn't. You can hold a gold coin in your hand, and it has value regardless of whether the power is on or off, regardless of whether the internet is working or not, regardless of whether banks are open or closed. That independence is what 2026 is teaching investors to value again. It's a reminder that for all our technological advancement, for all the sophistication of modern finance, there's still fundamental value in assets that exist independent of infrastructure and systems. This is the 2026 economic battleground. On one side, you have AI, representing the cutting edge of human technology, the most powerful computational systems ever created, systems that promise to revolutionize every aspect of society from medicine to transportation to scientific research. But this revolution comes with a cost, and that cost is energy. More energy than we currently have the infrastructure to provide sustainably. On the other side, you have gold, representing the oldest form of wealth humanity has ever known, unchanged in its fundamental nature for millennia, deriving its value not from technological advancement, but from its scarcity, durability, and universal recognition. These two things shouldn't be in conflict. They exist in completely different realms, one ancient and physical, one modern and digital. But they are in conflict, because AI's energy demands are creating economic instability that's driving a flight to tangible assets. And gold is the ultimate tangible asset. This conflict is creating a new kind of gold rush, but it's not driven by prospectors and miners searching for new deposits. It's driven by investors, institutions, and central banks recognizing that the world has fundamentally changed, that the energy equation that underpinned decades of economic growth and stability has been disrupted, that assets with intrinsic physical value, assets that don't depend on complex systems and infrastructure, are more important now than they've been in generations. The gold rush of 2026 is happening in trading floors and boardrooms and central bank vaults. It's measured in billions of dollars flowing into precious metals. It's visible in the price charts, showing gold reaching levels that most analysts thought were years away. And it's accelerating because the underlying driver, AI's energy consumption, shows no signs of slowing down. We need to be clear about what this means for different groups of people. For investors, this means fundamentally reassessing portfolio construction. The traditional 60-40 split between stocks and bonds that's been the foundation of retirement planning for decades, that might not provide the protection it used to, because both stocks and bonds are vulnerable to energy-driven economic instability. Adding gold exposure, real gold exposure through physical holdings or fully backed ETFs, isn't just about diversification anymore. It's about having assets that can maintain value in a scenario where energy costs create sustained economic disruption. For policymakers, this means grappling with energy infrastructure in ways they haven't had to since the mid-20th century. Building new power generation isn't just about keeping the lights on anymore. It's about maintaining economic competitiveness in an AI-driven world. Countries that can't provide stable, affordable power to AI infrastructure will fall behind economically, and that has implications for everything from employment to tax revenue to geopolitical influence. For business leaders, this means rethinking operational assumptions. Companies that assumed energy would remain a minor line item in their budgets are discovering it as becoming a major cost driver. Businesses that depend on AI tools and services are finding themselves exposed to energy price volatility through their technology spending. And companies in energy-intensive industries are facing competitive pressures from regions with cheaper power. This is forcing strategic decisions about where to locate operations, how to source energy, and whether to invest in captive power generation. For everyone else, for individuals trying to navigate their financial lives and plan for the future, this means understanding that the rules of economic stability have changed. The assumption that modern infrastructure is reliable and that the digital economy will just keep growing smoothly without major disruptions, that assumption is being tested right now. And having at least some exposure to assets that don't depend on that infrastructure, assets like gold, is becoming less about paranoia and more about prudent risk management. The intersection of technology, energy, and traditional value is creating opportunities and risks that most people aren't paying attention to yet. But the smart money is paying attention. Central banks are paying attention. The massive flows of capital into gold throughout 2025 and 2026 aren't happening because of some temporary market sentiment. They're happening because sophisticated institutional investors with access to the best analysis available have concluded that something fundamental has shifted, that AI's energy demands represent a structural change in the global economy, that this change creates risks to traditional asset classes, and that gold, ancient and unglamorous as it might seem in an age of artificial intelligence and digital everything, offers protection against those risks that nothing else can quite match. This is not just about 2026. This is about understanding the trajectory of where the economy is headed over the next decade and beyond. AI isn't going away. The technology is too powerful, too useful, too economically valuable. Every major company, every government, every institution is investing in AI capabilities because not having them means falling behind competitors who do. But the energy demands aren't going away either. They're going to keep growing as AI models get larger and more sophisticated, as more applications come online, as the technology becomes embedded in more aspects of daily life and business operations. We might develop more efficient chips and better algorithms that reduce power consumption per calculation, but the total amount of AI computation being performed is growing faster than the efficiency gains. The energy crisis isn't temporary, it's structural. It's the new reality of an AI-driven economy. And if energy instability is the new reality, then assets that offer protection against that instability become more valuable. Gold isn't a speculation on future price appreciation. It's insurance against infrastructure failure. It's a hedge against the risk that the systems we depend on become unreliable or prohibitively expensive. It's a recognition that for all our technological advancement, there's still immense value in things that are tangible, scarce, and independent of complex systems. The unforeseen economic battle of 2026 isn't really gold versus AI. It's traditional notions of value confronting new forms of systemic risk. It's the market trying to figure out how to price assets in a world where the most advanced technology we've ever created has an Achilles heel that nobody planned for. The conflict between AI's insatiable energy hunger and finite power resources is creating an economic dynamic that will define investing and wealth preservation for years to come. Gold sits at the center of it, not by accident, but because it offers something the digital age can't replicate. Value that exists independent of infrastructure, independent of power grids, independent of the complex, interconnected systems that AI simultaneously relies on and strains to the breaking point. We're witnessing a redefinition of what safe haven means in real time. And whether you're an investor, a business leader, a policymaker, or just someone trying to make smart financial decisions, understanding this shift isn't optional anymore. It's essential. Because the economic battle between gold and AI, between ancient value and modern technology, between energy independence and energy dependency, that battle is going to shape the financial landscape for decades to come. And it's happening right now.